Good morning. It's Monday, March the 10th, 2025. I'm Zach Howard. Here is your morning market update to start the week. Things in my notebook today. Rate of change. That's what matters most for markets, not the absolute. Is it getting better or worse? The data. This week we have inflationary data out of the US CPI on Wednesday. So we're going to be looking to see what happens there and how the market reacts. Probably a leading indicator for what's to come, but particularly in the following month as we see lower oil prices, less fiscal spending, disinflationary biases continue to hold up in terms of my backdrop for a forecasted outlook in terms of the macro regime. Next up, uncertainty. Markets hate uncertainty, and we are in an elevated time frame of uncertainty where we have off again, on again policy becoming very difficult for markets to price in risk, and thus we see increased volatility in that backdrop. Over the weekend, we had both the Trump administration continuing to hammer the table that expect recessionary potential, or at least at the minimum economic slowdown in the US. They want to get that message to the market now in advance as to the former of uncertainty. Coincidentally enough, in Q2 here, the US government has $4.5 trillion in debt they need to roll over that's maturing. We are approaching here 5-year anniversary where everybody and their dog levered up and basically borrowed money at a free cost when rates were zero. Not the least of is the US government, a bunch of US corporates. One space I'm waiting to see how it reacts here in the duration term coming up is the high yield space, which has a 5 to 7 year duration, and we really haven't seen yields break out in that most vulnerable side of the credit spectrum. So I'm looking at that in the second half of 2025 as a potential risk off area. But like I say, I think the US administration is really focused here on getting bond yields down to roll over that debt. The stock market, sorry, you're secondary. You need to take the fiscal hangover that the former administration give you, while the bond market gets the water and the immediate headache relief. That's what I'm seeing anyways out there in policy land and how it relates back to bond yields. Standouts from my notebook from a math data standpoint here today. Continuing lower lows in Bitcoin, new lows in the US dollar, stronger yen, stronger euro continues to be the theme. Lower lows, lower highs in all the three major US indexes, and lower lows in all those Mag 7 names at the end of last week continue to be bearish signaling to me. Combine that with a higher low, higher high in a bullish backdrop of higher volatility in the VIX continues to play the picture that we're in a risk off mode where if you have exposure to higher beta names, you are at a severe risk for drawdowns. So keep that in mind. It would not surprise me if we had a VIX handle of 30 in this uncertainty backdrop over the next week. And that would set up the possibility for further selling at these current levels. Have a great week. We'll see you tomorrow.